this Wednesday, the Bank of Canada is expected to announce the policy rate. And the only question right now is whether we're going to have a 25 or 50 basis point cut, because most analysts and economists are in agreement that we are going to finish the year with the 75 basis point cuts, and we're going to come into 2025 with the policy rate sitting at 3.5%. Okay, so that remains to be seen. Obviously, we want to know what impact those rate cuts are going to have on the real estate market, so that's the second topic of a conversation. And also in this video, I'm going to talk about the housing starts and whether they're actually catching up with the promises that we received from the federal government earlier in the year. So this is from betterdwelling.com. Canadian inflation slows, clears way for Bank of Canada to cut 50 basis points. Canadian consumer price growth slowed significantly in the latest report. Headline CPI fell 0.4 points to 1.6% in September, marking it the slowest annual growth since February of 2021. The decline was primarily attributed to gasoline prices, providing a large influence on the report. Excluding gasoline emphasizes the oddly large weight it represents these days. CPI excluding gasoline came in at 2.2% for September, unchanged from the previous report. So this is absolutely evident if you look at this graph here, where the darker shade of blue represents the CPI and the light blue represents the CPI without gasoline. So as you see, CPI without gasoline has been flatlining and it's sitting at 2.2%, which is the same as what we had at the last reading. The Bank of Canada's preferred core CPI excludes the most volatile components to minimize base effect influences. So the most notable component that's being excluded is food. When this is done, it reveals virtually no progress and slightly elevated inflation. Annual growth of core CPI was unchanged in September for both the core CPI trim, 2.3%, and excluding food and energy, plus 2.4% measures. And now I'm going to give you an opinion of the chief economist from BMO, Douglas Porter. It's a close call, but we suspect that the big improvement in inflation, the still high unemployment rate, and the still sour consumer and business sentiment will be enough to prompt the Bank of Canada to opt for a 50 basis point rate cut later this month. So regardless of whether we're going to get the 50 basis point cut this Wednesday, and even if it doesn't happen, we will likely be finishing the year with 75 basis points worth of cuts, ending the year with a policy rate at 3.5%. The bigger question is whether this will have any positive impact on the real estate market, whether the activity will pick up. And it's a very hard guess at this point for 2025, although for 24, I frankly don't expect a lot of things to change. Here's my reasoning. For one, the fall market is relatively short. We only have the time between the middle of September and the middle of December, and we are well past the middle point and rapidly approaching the end of the year. The market has not gained any momentum thus far. The sales volume has been dropping and prices have been trending down. So even if we do get to see a 50 basis point rate cut this Wednesday, this will unlikely revitalize the market in the short term. And the last announcement we're going to have is happening in December. Even if, again, there's a massive rate cut there, let's, for the argument's sake, it goes beyond 25 basis points and we do get the 50 basis point cut right now. So the policy rate in the beginning of the year is going to be at 3.25. So even if that's the case, there's simply not enough time seasonally for the market to recover. And when we're talking about recovery, we're talking about regaining that 16% loss that we've accumulated since the market's peak in March of 2022. So between now and the end of the year, the market, in my view, will continue trading sideways, and then we'll monitor the situation come 2025, depending on where the rates are sitting, depending on what the government bonds are going to be yielding, which will be impacting the fixed rate mortgages as well. We'll see where the volume of sales is going to be, and then we can comment on what's going to happen in the first quarter of 25 with both volume and prices. Just to add a few things to the previous topic, where this market is going to go, let's look at a few data points that betterdwelling.com had collected based on the recent report from Canadian Real Estate Association. Canadian real estate prices fall, market unsure if bounce is near. Canadian home prices continue to slip lower, though they remain range-bound. The benchmark price fell 0.6%, or $4,600 to $713,200 in September, leaving prices 3.3%, lower than last year. Almost all of the gains since the beginning of the year have been wiped out, with prices at a similar level to October of 2021. So we're here, based on this chart, in August of 24, and October of 21 is the point where we were at the same benchmark price. As you see, the highest level that we've ever reached for the benchmark was at $852,000 back in March of 22. As mentioned, prices are still coming down, though the size of those drops is smaller. Annual growth at 3.3% in September is an improvement from August of negative 3.9%, but that has more to do with the size of the decline. From August to September, prices fell in both 23 and 24. The drop is clearer when compared to the record highs. Since peaking in March of 22, the benchmark price dropped 16.3% by September of 24. A peak buyer would have seen losses increase by 3.4% last month. Year-to-date gains still haven't rolled back, but home prices are still decreasing. So this trend is unlikely to reverse between now and the end of the year, regardless of what we see happen with the Bank of Canada announcements in the coming 2 months. And now let's talk about housing starts, because this relates directly to the affordability of homes all across Canada. And we've received some promises from the federal government back in the spring of this year. So this particular article is titled "Canadian Housing Starts Stagnant. 3x Growth Was Never Realistic." And that's coming from a report from BMOs. Why are they talking about the 3x growth? The reason for that is this announcement, the Trudeau government's promise of 3.87 million new homes by 2031. And this article from April of this year from the Globe and Mail is telling us that it's next to impossible. Well, now, 6 months later, we're seeing that it is actually completely impossible with the current level of housing starts, which are sitting at 244,000 units for September. In order for us to be able to realistically reach that goal of 3.9 million homes over the next 6 years, we need to triple the starts. And this is not exactly going to happen this year or likely next. And the reason for this is this: market conditions are making it tough for builders with higher borrowing costs, and importantly, the disappearance of investors that are often leaned on to bring projects to the construction phase. Well, of course, those two factors are critically important, but on top of that, you have much higher construction material costs, you have higher labor costs, and you have higher input costs. And developers have to contend with all of that and still somehow manage to make a profit. They're not running charities. They're in there to make profit. And if there is no profit, there is no construction. As simple as that. Further, investors represent upwards of 70% of pre-construction demand in major cities. This buyer demographic, with access to significant leverage, helped to drive prices much higher by outbidding end users. And by and large, investors lost interest in purchasing pre-construction at this point. There are 3 main reasons for that. Number one, the prices for pre-construction properties are simply too high within the current marketplace. They're not supported by any of the sales. Second is that the interest rates are still higher when they should be, considering the prices that the builders are trying to charge for their pre-construction units. And lastly, the rents have been falling. So let's look at the report from rentals.ca so you can see for yourself where the rents are sitting at. For Toronto, for 1-bedroom unit year over year, we have a decline of 8.1%. And for 2-bedroom units, year over year again, we have a decline of 8.2%. So it's a perfect storm, and investors are not interested in buying pre-construction units at this juncture. We'll see what's going to happen in 2025. It's very unlikely that anything will change between now and the end of December of this year. I want to make sure that I drive this last point home. No matter if we're going to have a 25 or 50 basis point rate cut on Wednesday, it will not impact the real estate market in any significant way. It will likely continue trading sideways between now and the end of the year at the very least. So once again, if you're trying to make a decision on when to sell or when to buy, I suggest that you base it purely on your life circumstances as opposed to trying to time the market, because the market is extremely volatile right now, and that volatility will most likely extend into 2025 as well. If you're not sure about how to go about a buyer's journey, or you're not sure about how to position your property up for sale, especially given the complexities of the current marketplace, reach out to either myself, Vlad, or to my partner Mitra. I'm going to include a link to our calendars in the description below. The process is simple. You connect with us for a 15-minute phone consultation where we're going to talk about your objectives. That's about it, guys. If you like the content, hit the like button. Consider subscribing to the channel so that you don't miss new releases that are coming out on a weekly basis. I'm looking forward to seeing your comments in the comment section below. And I'm out till next week.